thank you for joining us. It's an honor and a privilege to be with you as we start our 31st anniversary year and have our 25th annual resource event. Joining me today is a very special guest, Paul Reilly, the chairman and CEO of Raymond James, along with our own Nick Warsh and Raj Chatterjee. During the event, you can email me personally questions. We've received a number from you that we're going to chat about today. I started in the business in 1986, and by 1990 had the vision for a new type of firm focused on service and really helping people achieve their personal vision, whatever that may be. Now, clearly a lot's changed with the economy, investments, and the world, but the values that we founded our firm on and the mission of making people's lives better remains steadfast. So today, we're going to be looking at the year and the decade ahead. Now, I think we have a choice in what story we choose to tell of 2020. It was either the worst of times, or perhaps it was the best of times. And it's important because the story that you tell yourself and others may affect how you live your life today. Looking back over longer periods of time, virtually all facets of life are getting better. And moreover, while the markets don't like uncertainty, they can assimilate bad news, however you interpret that to be. So 2020 clearly presented a lot of challenges and problems, but it also highlighted the characteristics of endurance, courage, selflessness, faith, unity, adaptability, and caring for others. And those who stuck with their financial and investment plans ended up doing quite well. So often it's difficult to see where the world is and really how well things are going because we have a mental filter that favors the dramatic and the short term. And this is certainly exacerbated by the media. And we've talked about this for 25 years, that the media is generally focused on the short term and the negative. The thing is that today we have more media, whether it's magazines and newspapers, commercial TV stations, over 1 billion websites, and hundreds of cable news networks, with more popping up every day. The result is we may have an exaggerated and overly negative view of the world, which can create unnecessary fear and stress, and it may not reflect the way things truly are. The problem is when we're operating on the wrong facts, we really can't develop solutions and make good decisions. Now, when I started in the business, the biggest part of our job was getting information to people. You might have received a 401k statement once a year. There were 3 TV stations, NBC, CBS, and ABC. Now, our job is really filtering that deluge. It's like drinking from a fire hose to try to help our clients see what's relevant to them and what's important. So as we look ahead and the key issues that we're focusing on this year, one, I think it's certainly important to look at the impact of the election, both the federal election and the outcome from Georgia this week. We need to look at tax policy for 2021 and beyond. We certainly should talk about what's happening with shutdowns and reopenings due to COVID, and also the resulting tax and legislative policy that's going to come out of all of that. Now, while 2021 certainly faced some challenges, for Carver Financial, it was an interesting year. We finished the final phase of our building expansion. We actually had our open house about 4 weeks before all the COVID shutdowns. We recommitted to some of the technology. I think there's a big trend in the industry and really nationally to replace people with automation. We view technology as a way to support conversations, not to replace them. We launched a new website with a lot of new resources that Nick's going to talk about in just a couple minutes. We deployed some new technology to monitor and rebalance portfolios that Raj is going to talk about. And we've continued our partnership with Raymond James that started on December 17th, 1990. And it's been a wonderful partnership. And I think the importance of that relationship today is even more significant, perhaps, than 30 years ago. Now, all of the technology that's out there certainly is very powerful, but it can also pose risks, both from a personal security standpoint and also from a misinformation standpoint, as we get sometimes misleading, sometimes incorrect or incomplete information via social media and the media. As I say, one of the things that we're committed to is maintaining that personal interaction, so we have those conversations and using technology to support that. Now, as we look ahead at reopening, we've remained open, and our office has followed a number of protocols. As an essential business, we didn't close. We continue to use face coverings. We've enhanced our cleaning procedures. Our staff members are very diligent that if they don't feel well, they don't come in and they do get a COVID test. And really the biggest thing is a focus on virtual meetings. As many of you know, I have a number of health challenges and therefore perhaps are overly cautious. What we found is the virtual meetings can actually benefit everybody. It's a way you don't have to go out in the cold. And certainly as we meet with clients around the country, it's been a very, very interesting thing. Now, we're here for you. And the better that we know you, the better we can serve you. In the mail, you'll be receiving an affinity form if you haven't already received it this week. This is just a questionnaire. We want to get to know a little bit more about some of your preferences, hobbies, interests, those types of things on a personal level. The second thing that we're going to be sending that's very important is an email survey. You'll be receiving an email from me next week that'll have a link to a questionnaire. We ask that you take 5 or 6 minutes to complete that so that we can get a better sense of what's important to you and how it can better serve you in the year and years ahead. Your information can be anonymous. It is going to a third party that won't disclose. Or if you want us to know who you are, you can certainly sign it. As always, all of our team's here to listen to any questions, concerns, or anything else. You can speak to any of the advisors, the team, or to myself. As I said a moment ago, we launched a new website that was the culmination of a one-year project that our director of marketing, Kelly Drum, was key in pushing this through. And on the website, there's a number of resources that Nick Warsh, one of our senior advisors, is going to discuss right now. Nick's been with us 11 years. He's a certified financial planner, and many of you know him. So, good morning, Nick.
Morning, and thank you, Randy. And thank you to everyone joining us today live and those that may catch this recording after the event is done. Like Randy was saying, a couple of years ago, we started a project to enhance our website. So I think something that's important for clients to remember, or those that are just meeting us for the first time, is we have a client-first mentality, and we also have a growth mindset. That means we put the client's needs first in their planning and their portfolio management. And internally, we're constantly thinking about how to enhance the experience for our clients, hence the update to the website. So the first resource on our website that is new is our videos. So throughout the year, we host several client events. Some of those we're able to record if given permission by the speaker, such as this one today. And it will be posted under that part of the website after the event. Next year, we're hosting several client events. And the thing we're doing to keep in mind when developing these events is we want to provide some ongoing education, and we also want to inspire people. Right? The second resource on our website takes us to the client communications. Every quarter, clients of ours receive a memo in the mail, and monthly they have a Swift page email. And again, we're trying to provide ongoing education and inspire. If you happen to throw it away or just miss it, you can go to our website now and pull up the historical archive of those communications. The third resource on our website is brand new. And this has everything to do with client access, which is the way our clients view their accounts online through Raymond James. So now we have a bunch of short videos. If you have any questions, you certainly can always give our office a call, and we're happy to help you through the process. But this page will give you some tips or tricks as how to maybe manage or view different things through client access. The fourth resource on the website is also brand new. A lot of times we get the same questions, so we thought we'd put those questions together and add them to our websites under a FAQ page. So the thing to keep in mind for us is we are a referral-only business, which means our business continues to grow by people telling others about us. So we appreciate those, and if you can point individuals to this page on the website, they might be able to learn more about us before we meet them for the first time. And the last new resource on the page has everything to do with our events and also the client trips, which Randy will touch on later in the presentation. So with that in mind, Randy, take it over.
Thanks, Nick. It's great. So the biggest question I think we're getting right now is, what do you think is going to happen as a result of the election? And we can look back and see what the various outcomes have been with different scenarios, one party keeping all three houses, et cetera. Bottom line is, typically in an election year, the markets have done fairly well. But as always, past performance really doesn't guarantee anything. Moreover, the question of what do you think is going to happen isn't the right question, in our opinion. The right question is, with what's going to happen, how will it affect me? And if it's not going to affect you, then it's more of an academic discussion. And the fact is that because of our personal vision planning process, we feel it's not about crystal balls and trying to predict. We want to plan both for the known and also the unknown. When we did this meeting last January, we had no idea that the big issue would be COVID. The risks at the time that people were concerned about really were North Korea and a trade war with China. If you think about that now, it seems like an awfully long time ago. Part of our process is setting aside funds so we can ride out the unexpected. Now, there's always a reason not to invest. Here are 83 of them, in fact, that have occurred over time. And that's nothing new. And in fact, as we said, if you look at some of the headlines, even in March, circuit breaker halts the stock market, Dow ends bull market, coronavirus pushes China's economy to the brink. Pretty dire stuff. And the Dow is at roughly 20,704. Well, here we are, less than 9 months later, and the Dow's over 30,000. Had somebody reacted to just the media, that they would have missed a 50% move, 50% move up. The fact is that volatility is normal. One of the phrases that drives me crazy, and you've heard it a million times during this COVID situation, is, in these unprecedented times. These times are not unprecedented. We've had pandemics. We have market volatility. We've had all of these types of things. Volatility is absolutely normal. Now, do we think there's going to be a correction? Yes. The fact is, the market corrects about 5% every 2 months and 10% about every 8 months. Because the Dow, which is what a lot of people look at, whether it's relevant or not, is so high, a 10% correction is 3,000 points. The fact is we get a 20% correction every 30 months. So do we believe there'll be a correction of 6,000, 7,000 points? Absolutely. When will it be? Don't know. And really, it doesn't matter. The worst thing people can do is to panic and jump in and out, not just as pointed out this year, but if we go back, we can see over the years that virtually every year there's a significant drop intra-year. The orange lines, although it's hard to see, and we'd be happy to send any of you this chart, it's also in the back of many of the client reviews we've done in the past. The orange line shows the intra-year drop, and the blue line shows where we ended up. Now, the interesting thing is that 96% of market returns happen in 0.9% of the days. So if you look at 1963 through 2004, 40 years, 135 days out of 14,000 days accounted for virtually all of the return. While we're good at what we do, we certainly can't tell you what days those are going to be. And again, I think if you look at November and December this year, it's indicative of how we can be surprised. The problem is, if you miss just a few of those days, it can significantly cost money. If somebody had been invested from January 1 of 2000 for 20 years and just stayed in the market, they would have ended up with $324,000. Had they missed the 25 best days, it's really 1.25 days per year, they would have actually lost money. And after 20 years, had less than they started with only $82,000. Now, I know that's a lot of math on a Saturday morning, but the fact is, market timing, it's impossible, and it can be very detrimental to your returns. We absolutely don't believe in timing. We do believe in reallocating, and that's one of the things Raj is going to talk about. You can't just sit. It's important to be proactive in the management, but not based upon the markets. The other thing is percentages can be very, very misleading. People look at the percentage and they may not realize that it has little or no bearing on how much money they make. The absolute key to making money and building wealth over time is minimizing volatility. So if we look at two investments, investment A has a hypothetical 2-year return of 22.5% each year. So 45% over 2 years. Investment B only made 6% per year over the last 2 years. You would think, looking at the track record, that investment A was obviously much, much better. But if we look at the math a little bit, on investment A, if we invested and somehow our $100,000 investment went up 100%, the 100,000 would have grown to 200,000. In the second year, if we went down 55%, we would have dropped all the way down to 90,000. 55%, 200 is 110. So we started with 100, we ended up with 90. Yet, if you take a simple average return, 100% minus 55, that's a 45% return. Divided by 2 is 22.5% per year. Investment B made 6%. So at the end of the first year, 106. At the end of the second year, 112,360. 6% average return, we have $112,360 as opposed to 90,000. Certainly more money. And again, it's because of managing the volatility. So our personal vision planning process, it's not based on the markets. It's not based on crystal balls. It's absolutely based on you. First of all, accounting for the anticipated cash needs and overall needs that you have. And then also take into account the unforeseen, taking a very proactive approach to what we're doing. Now, this is something we've done for 30 years. In the middle of 2000, in July, we had two major changes to how we do this for you. The first one is, working with Raymond James, we developed a proprietary algorithm to monitor portfolios. And second of all, we began using what's called discretion. So Raj, another senior advisor, certified financial planner, is going to discuss this for a moment and explain where we're at. So good morning, Raj.
Good morning. Thanks, Randy. So as many of you know, you've been speaking with your advisors over the last few months, and we've been updating the platform that we use to manage the client investments to the term discretion. Okay, so the main tenets that we've always believed in of proper asset allocation, knowing what your needs are over the near term and the medium term, providing the proper diversification and rebalancing the portfolios, that hasn't changed. What we are looking to do is identify technology where we can more effectively manage these portfolios and take advantage of opportunities that present themselves. So we've been working with Raymond James Home Office. We're piloting this new rebalancing and trading platform where we can identify when client accounts are out of tolerance. So each of you have a target allocation of where we want to keep the portfolio based on your individual needs, circumstances, and objectives. As that allocation moves out of tolerance, we're able to get alerts that state that this portion of the portfolio is overvalued, undervalued, and we can go in and rebalance that portfolio back to target. So a lot of times people think that this is just a computer program or an algorithm automatically doing this. That's not the case. We're just leveraging the technology to alert us. And we, as the advisor, will still go in and manually say, yes, acknowledge that, and then rebalance the portfolios. Over the latter half of 2020, we saw a strong run in the market. And so many equity allocations became overweight. Over a 2-day period at the end of December, we were able to rebalance over 2,000 accounts. So this systematic rebalancing to take advantage of that growth and rebalance it back to conservative types of investments and or fixed income is a positive for the portfolio because we could take some profits and shift them back to the conservative types of investments. If we think back to last March, when we were going through a very volatile period of time, there were opportunities where we could create tax swaps, meaning we could sell an investment that had an underlying loss, take those proceeds and simultaneously invest them into a like-kind investment, but then capture a tax loss that could be used to offset future gains and or potentially deduct from income taxes. It's a benefit that helps the portfolio, helps the tax situation moving forward, but it gives us the ability to screen right away client accounts that are out of tolerance and have these tax opportunities. So our experience with Raymond James has been great. You know, with us and our relationship with them, we've been working hand in hand, having weekly conversations, talking to them about the system itself, how we are utilizing it. And really the benefit is for you as the client, the system that's going to be rolled out to Raymond James is basically designed for our office. And we feel that we have a lot of say in what benefits and attributes help the management of the portfolio. And we've really been able to customize it. So over the next few months, as you continue to have your conversations with your advisors, this is a topic I'm sure that each of the advisors will talk to you about. But it's been a very good transition, and we're already seeing some of the benefits of being able to more proactively manage these portfolios.
That's great. You know, and one of the things I think that's important with what we do is we do work as a true team, whether it's Raj or Dick or Gail, Mark, or any of the other people, Nancy, Bobby, et cetera, Dan and Joe, plus the other 20 some odd people, everybody's working together for you and with the same vision and the same mission in helping clients. And I think that's critical. Now, what lies ahead? We've seen the results of the election. We think there's going to be a number of changes. And we're going to touch on this again in a minute. But very quickly, a summary of the tax plan proposals. The first thing you may see is a repeal of the Tax Cuts and Jobs Act. And essentially, the Biden administration has said they want to significantly increase taxes for people that make over $400,000. One of the biggest changes would be a new 12.4% Social Security tax on top of income tax. Right now, the Social Security tax is capped once you make about $132,000. There would then be kind of a donut hole, but then over $400,000, there'd be a new 12.4% tax. The second big change is an increase in the corporate tax rate domestically back to 28%. But even more significant is establishing a minimum tax on book income, meaning a lot of companies shift income overseas and therefore don't pay tax. This would impose essentially a mandatory tax, increasing the tax rate on some of the overseas things with the GILTI tax. And one of the biggest changes that people have heard about is taxing long-term gains and qualified dividends effectively as income when you make over $1 million. Right now, it's the taxable gains rate's 20% plus potentially a Medicare surtax of roughly 3%. So about 23%. That would now go effectively to 42%. And then lastly, an adjustment in the estate tax, and more significantly, the step up in basis. The other thing they're talking about is forgiving student loans. As with anything, the devil's in the details. And the debate now is, if you forgive a student loan, is the person now responsible for income tax on that forgiven loan? And how would they pay it? So if a student owed $50,000 and the government waves a wand, says no more tax, do you then get a 1099 for $50,000? Stay tuned. One of the things I think we should say is there is somewhat of a natural buffer for some of the more radical things, in that there will be another congressional election in 2 years. Politicians want to get elected. And one of the things we saw out of this election was definitely people are not happy with socialist type policy. The Republicans didn't lose any seats in the House, and they actually picked up some. They also picked up several state legislatures. And so, despite the outcome on the presidential level and the Georgia runoff, I think both in the House and the Senate, people are aware you don't want to move too far to the left because it could jeopardize certainly the electoral prospects coming up. One of the things I do want to touch on is with regard to the estate planning, because one of the things that they're proposing is not just to raise the top tax rate on capital gains, but to eliminate the step up in basis for estates. So right now, if you have an asset you paid $1,000 for, and now it's worth $100,000, when you pass away, that becomes the new basis. So if your children were to sell it, there is no tax. What they are proposing is the children would then owe a tax on the $99,000. The other question is, do they have to pay it immediately, or is it the time the asset gets sold? This is a very, very important thing, because if taxes were due immediately, people would have to sell things to pay the tax on the estate. Some of you may remember the Joe Robbie family. When they inherited the Miami Dolphins, they had to sell the Dolphins to pay the tax on the inheritance. So in the coming weeks, we're going to get a little bit more clarity as far as that goes. We would absolutely encourage you to have your estate planning reviewed. The fact is 42% of Americans don't have an estate plan. If you don't, please speak to an attorney. If you don't have one, we can refer you to one that can help. We do have powers of attorney through Raymond James that we can offer. However, that's only for the accounts with us. So we absolutely recommend speaking to an attorney. And if you've done your estate planning already, it's important to review it. Not just because of what's happening today, but because a lot of the provisions are going to sunset. Now, you guys have seen this slide forever. The four most dangerous words for investors are this time it's different. It isn't. We'll see different things in the coming year. There are things that are going to happen that we can't even begin to predict. But thinking that things are going to be different is what leads to market timing and panic, and certainly causes most of the problems. The biggest challenges that we see investors facing are the same challenges that we've discussed for 30 years. Inflation, the fact that dollar tomorrow is not going to buy what dollar today does. And many of you have heard me ask the question and put up your hand. How many of you paid more for the last car you bought than the first house? That's inflation. And with people living longer and staying healthier longer, your money has to last. The only thing that will keep up with inflation is owning equities. The second risk being catastrophic medical expense, which we can, in some cases, insure against. And finally, making bad decisions based on media hype, emotions, or bad information. And that's why we're here. Please, if you have questions or concerns, speak to your advisor. Now, 30 years ago, I was working for a regional investment firm, and I really didn't like the fact there was a sales and investment organization. I felt there could be something better, a new paradigm in really helping people achieve their personal visions. Investments just being a vehicle to do that. In order to provide investments and investment accounts, you must partner with a firm to custody the assets. And at the time I did a search, and the firm that I selected was called Investment Management Research, which was Raymond James. Over the last 30 years, it's been an incredible relationship. And as Raj said, we work closely with them and they support us. Raymond James allows us to provide you with the personal attention for a local office, but the resources of a Fortune 500 company. We have access to a full trust company, an investment bank, and really a regular bank, just to name a few. One of the most important things about Raymond James is that I felt they aligned with our beliefs of putting people first. And that's becoming more important than ever. Perhaps one of the visible signs of their commitment to us, and indeed to you, is the fact that their chairman and CEO, Paul Reilly, is joining us this morning. So it's truly an honor and a privilege to introduce Paul Reilly.
Thank you, Randy. Good morning, everyone. It's great to be here. I'm down in Florida where our headquarters is and kind of in my den here. So if kids walk by, we have some staying with us working from home. They may wonder what I'm doing, but that's part of life today. It's really been an incredible year. 2020 was, different than any of us expected. And I think as Randy said, if we had said that, hey, everyone's going to be at home, economies are going to shut down, people are going to stop traveling, and what's going to happen to the market, we would have been wrong. So his view of, planning for your personal needs and not trying to predict the market is absolutely in the same philosophy as Raymond James. And in fact, when Randy joined us over 30 years ago, Raymond James was a small company. Randy was just starting in the business. And I think what's led him to be our largest independent advisor, and certainly if you look at Forbes or Barron's top financial, one of the top financial advisors in the country for all firms, is that focus on client first. And that's been the same with us. At the center of what we do is we remind ourselves every day as your financial well-being is our goal. And we view that advisors are our clients. Our job is to give them the tools, the resources that if they need them, that they can better service you, because that's the end of the day, the measure of success. And that's led for success at Raymond James. We went from a very small company into the Fortune 500, almost 400 now, and the S&P 500, which is kind of an honor because that's measured on profits and is part of the economy. But that's not really our journey. Our journey hasn't been about size. It's about being the best we could be. And in fact, 10 years ago, when I took over as CEO from our founder, Tom James, or son of our founder, we put a vision on to be the premier alternative to Wall Street. And by that, I meant we wanted to be an organization that was big enough to be able to help our advisors do anything that they could get anywhere. It'd still be that small feeling firm that's personal, that I can reach out like this, that the relationships in our firm, I actually miss seeing Randy and Nick and Raj. We see each other. It's a personal thing, even at a firm our size. And that's really important to us, to have that intimacy, because we're all here to help serve you, and that reminds us. And we've grown. We've grown because our focus is, when in doubt, always say what's best for the client. It's the center of our core values. The second is a long-term focus. Just like Randy has talked today, we're not going to plan for the short term. We're going to plan for your financial goals or the way you're going to live over time. And we've always taken that. A lot of public companies look at trying to say, how do I get my profits up? What's my stock price? I don't even look at our stock price. The times I look at it are when we release earnings, and then I ignore it for a quarter unless people call me and say, we went over $100 as we did this week as the market surged. But that's not the measure. The measure is, are we going to be better 5 years from now? Are we going to be better at serving our clients, the advisors, and helping you 5 years from now? And that's resulted in a remarkable, for our industry, run. Our stock has grown about 19% compounded since going public. But even more importantly is that financial stability. And this is like Randy's chart of, the 6% versus the 20-some percent, is we don't try to hit home runs. We just try to be a steady processor. And that's resulted in almost 130 quarters of consecutive profitability. When you think of that, over 25 years, every quarter we've been profitable. I'll take you back to 08 or 09, when a lot of financial institutions went broke or had to be bailed out by the government. We had our worst year at Raymond James history. We had a 7.9% return on equity. We made money every single quarter. And people asked, how did you do that? What did you do this year? It wasn't what we did this year. It was that long-term value focus of being conservative, looking for the long term, knowing there is going to be downturns. If those downturns happened, we would be fine. And that conservatism is shown in which is our third value, conservatism, in the way we're capitalized. We have, to be well capitalized in our industry, you have to have 10% Tier 1 capital. That's a regulatory requirement. Most firms that are well capitalized are around 12% Tier 1. We're over 25% Tier 1 capital. Now that impacts our returns because we're measured against return on capital, but we look to the long term. It's a significant business. It takes about $1 billion in cash to have plenty of cash even in downturns, but we keep over $2 billion in cash. Why? We want to know when events happen like in 2020 and in March, the markets were in trouble for a week or two, that Raymond James was fine, that you are fine, that your accounts are protected because we have a solid balance sheet. And in fact, if you look at S&P and Moody's, who rates companies, they rate the debt on companies, Raymond James S&P rating is the same as Bank of America, Morgan Stanley, and Goldman Sachs, even at our size. And that's because of our stable, long-term earnings and approach. And we do it because we think it's a mandate on how we should operate to protect you and our client, and your well-being, as well as to have a steady home for our advisors. People know we're going to be here to service them. And last but not least is independence. We value independence. We value Randy's independent, that he makes decisions independent of what's good for Raymond James for you. If Raymond James can have a product or a service that helps you, he'll call on us. If he thinks someone else has it, he'll use those. And that integrity and that independence enables him and Carver to deliver, what you need in your best interest. But that's also good for us in the long term, because if we continue to do that, to make sure our advisors are delivering what's best and in your interest, you win and we win. And that's the view here at Raymond James. And I think that's why our partnership with Randy over these 30 years has been so great. It's because we share that value. Is our job is to make sure that you're okay. And I'll tell you, as a CEO in this industry, it's really an honor and a privilege to work with people when you have everyone here that feels that way. None of our executives have contracts. They could leave, they could get fired, but they all stay because they want to be here. They believe in the company, they believe in the values, and they believe that our job is to help you. So with that, it's great to be here this morning. I know Randy said he had some questions for me, so I'll just go ahead and open up for questions.
Thanks, Paul. Yeah, the clients were kind enough to send some things. And the first one, I think, is something that gets asked a lot, is how safe is my account with Raymond James? And I think, for people listening, as you all know, and as Paul said, we're totally independent. We can work with any investment virtually anywhere, but we do choose to custody the assets of Raymond James. So your statements come from them, your investment access is through them. So really you're getting independent third-party reporting. So you don't have a Bernie Madoff situation with what you're getting. We're looking at them, they're looking at us. But the question we received broadly is, so how safe is my account?
So we, through our overcapitalization, regulators saying need to be 10%, we're 25%. We're 2.5 times the industry. I don't know anyone that does that. And that's part of our operating model. Maybe 2.5 times is a lot, but we've always been at least, kind of 18 to 20%, because for the same reasons. We feared a correction or coming on. We didn't know about the coronavirus, so we were conservative, more so conservative than even our normal conservatism coming into this last year. And we know corrections come. We didn't expect meltdowns, and the financial markets were in trouble in March. Working with the industry, if it wasn't for the Fed stepping in, there were a lot of issues in liquidity and other things, just like there was in 2008. The good news is the banks were well capitalized. The Fed stepped in. And so I think it's that. And, our conservatism and our capital is what keeps your account safe. But it's more than just the financial wherewithal. It's all the other things we do for your account. So, for example, I remember 10 years ago when our cybersecurity was a handful of people and a couple of pieces of software. Today we have over 120 full-time people monitoring, going around the globe, handing it off 24/7, over 40 pieces of software, monitoring attempted incursions that come in by the thousands to every financial institution. So you not only put up walls in a fort, you put internal walls in so that if someone ever happened to get in, it's like going through a maze that you might be in, but can you get data out? And you have to weave your way through, and you can stop people. The sophistication today is amazing, but it's the one area in our $400 million technology budget that we never cut, that we always say whatever they need, we put in there. And our regulators and others tell us, we're kind of a top decile cybersecurity organization, which is great, but it's a real threat, as you could see around governments. And we go a step farther. We do things that I think other people in the industry don't do. And I'll give you an example. The SEC proposed a rule called CAT, which I'm sure most people on this call have never heard of. It's called Consolidated Audit Trail. And what they wanted to do was be able to monitor all trades, which they can do today by requesting them from us or requesting from accounts. It's their right. But they wanted to take the personal financial information, your name, addresses, social security number, others, and put it in a central government repository so that they could have quick access. And we stood up and said, this is crazy. We know you will get hacked someday because it's too rich of a data target for government states not to go with. Well, they kind of poo-pooed that. They didn't after SolarWinds, the most recent. But we were effective. We formed an organization with 3 other regional firms called the American Securities Organization to lobby Congress, both sides, to say, hey, look, this is personal financial information. Why should they put it at risk? What's the cost benefit of it? And finally, our organization sued the regulators, the SEC, saying, you proposed a rule without the proper process, cost benefit, with huge risks to investors. And the SEC pulled the rule this year. Now, we don't like to sue our regulators. It's like suing your police force in your own town. But we had to. It was bad for clients. It was a risk for clients for no other reason, because technology would allow access to the data. But why should that data be at risk? So we're not afraid to step out. And so here's an indirect way we're protecting your information, because we know the security of our systems. We also know that hackers, to get all that information, would have to hack hundreds of broker-dealers. Why put it in one rich target? So we'll continue to fight those kind of battles for you, for all investors, but particular focus on protecting your clients. So I think you're in a very, very safe place.
Thanks. So pivoting a little bit, because again, you can't miss it. How do you feel the political climate right now is going to affect the markets and investors, and what should our clients be thinking about? Obviously, you speak to people in Washington and elsewhere. What are your thoughts?
So we all have always said the market likes certainty, but we've seen a lot of uncertainty this year, and the markets did fine. So it's very, very interesting. That certainly, I think we don't look at who's elected, Democrat, Republican, to really take a market view. We look at the overall economy, and we look at the policies in place. So it's very clear that, and I think Randy's point of it really matters what impacts you, and broader for society, your children and everyone else, but from an investment standpoint, it's what impacts you. So the market probably, most people would expect it to do well early on with additional stimulus as it passes, additional infrastructure programs, those all spur economic developments. But as we all know, you have to pay the piper. We have the largest trade gap this last quarter that we've had ever. And then as that debt piles up, you can do well in the short term, but long term, how do you pay for it? So that's the concern. So we know there'll be ups and downs, as Randy has said, but I think the right thing is to say, okay, the market's going to have ups and downs, and it could have a year or two down before it comes back. That's not unprecedented either. What you have to do is look at which of those, first, how you're positioned, and secondly, which of those policies will impact you. And I think the immediate things will be income tax, where you're situated in that, and estate planning. And I think Randy's really touched, those are the key rules that'll really impact investors. There's certainly shorter term in this coming year. I don't know if the Biden agenda will say, let's get a lot of things done quickly, because you usually have a honeymoon, or he's been known as a consensus builder. Well, he'll take his time to build an agenda with both sides to try to keep people together. So time will tell. We don't know. We don't know the outcome, but certainly I think the points Randy put up are the right points to think about from your individual investing.
So obviously, a lot of talk about COVID. I think we had a very interesting discussion with Kevin O'Leary a couple months ago, and his thought was COVID really pushed a lot of companies to pivot digitally faster than they would have. And what he calls USA 2.0. So really a positive from all of this. And the fact is that while certain market sectors, primarily small mom and pop type business, have been negatively impacted, there's a lot of positive too. But what are your thoughts? We're hearing about the vaccine, not from a medical epidemiological standpoint, but really thoughts around COVID, where we're at, where we're going, what the implications are, and really maybe what's happening at Raymond James, as a result of it.
Yeah, so let me start with kind of Raymond James and our reaction. We were fortunate, not that COVID hit, but again, that we were uniquely prepared, that we have put out mobile programs. Our advisors could do most of everything they could do on their cell phones that they could do from their office. We've been investing in mobility. We had hired a head of mobility from one of the major accounting firms that had put 50% of their workforce mobile and brought them in and said, look, your goal is to get 30% of our people mobile, completely mobile, and others more flexible within 4 years. Of course, he started March 1st full time, and he told me 2 weeks later that he met his goal because we were 90% everyone working from home really in a month. Good news was our systems could handle it. We didn't have any outages that a lot of the big firms had during that period of time of transitions. Huge volumes, and even people from home, and I give credit to our associates that worked really, really hard from home with their kids working, going to school and working from home and all the distractions they get from it to really service you and take those calls. And we had some days that were backlogged, and it took us through, late those evenings to get them serviced, but we would have had that in the office. So what happened is there's a trend that we knew was coming and we were preparing for, and it got accelerated. We've had tools like e-signature, or using Zoom, which we've had Zoom, again, how we were prepared. A lot of firms had to pivot to use something like Zoom. And there was resistance to using it, sometimes by clients. I'm not comfortable with an e-signature or a Zoom meeting, where's the in-person? But I think we've learned, as much as we miss the personal interactions, that we can actually carry on business. So I believe the remote working, the electronic tool adoption was accelerated a decade. It was happening. We knew it was happening. We were preparing for it. And the question's going to be, what is a normal return? So at Raymond James, we were very clear. We sent people home until we had a handle on the virus. And now we allow people in the offices, but they can't be forced. It has to be their choice. We have to have social spacing, so we put maximums, in our employee branches, 50%. Independent branches can do what they choose, like Randy and his policy, which is very consistent. And our headquarters, no more than 20%, because, the virus is a serious thing, and we're still having growth in cases. So the vaccine's very hopeful. From every source I've heard, both, people we use and everything, that it should be effective. Now it's got to get out, right? So our view is once enough people are evacuated, we can start return from office. But yet we know that a lot of people that work from home aren't going to want to work from the office, even if it's 100% safe. Now, some of those jobs, that's fine, but for some jobs we need to be together. So that return to office, first we have to make sure it's safe for people, that the vaccine's out, that it's effective, to start putting people back to office, and that I think is throughout the world with that same challenge. And then we're going to have to figure out how we operate going forward. I'm convinced we'll need less real estate because there will be a percentage of that workforce that'll choose to be mobile. There will be a larger percentage that will want to work occasionally mobile, which is fine. We see that people can get the work done. But the other part that is hard is people miss seeing each other. I don't know how many times a year Randy and I see each other, and the fact I'm in Florida and he's up in Ohio where our weather, we're having our coldest day of the year. It's like 57 degrees is the high. Everyone's panicking in Florida. But that distance isn't distance at Raymond James, because I see him at least a dozen times a year. We travel together, we get to know each other, I know we understand his business and his needs, and we miss that. We miss that people part. Everyone does. So the balance isn't, I'm not sure exactly how it will come back, but I know we can navigate it because we've shown if we can be 95% working remote, we certainly can be 30% or 40% working remote. And we're just going to have to see what the balance is, what employees, our associates want to do, and then how we can make sure we can cover the business and cover your needs, really. If we can service our advisors and your requests, then there's no reason not to have that flexibility. So it's going to be an interesting time, return to work. But our premise is we're not going to rush. We've gotten through this part with very few, cases. We have 12,000 people, so we did have a couple of deaths of associates, which are tragic, and they serve as reminders that we have to take this seriously. So we'll take it deliberate, we'll take it slow, and when the evidence shows it's safe, we'll start, opening back up and having conferences like Raymond James live again, and hopefully meetings like this live again where we can see people.
Thanks, Paul. So, I've noticed certainly in the last few years, Raymond James has made some strategic acquisitions. Really, it seems to provide new resources to clients, whether it's the Alex Brown or more recently the pension administrator. So what can you share with the clients before we wrap up? Okay, what types of new resources do you see Raymond James having for clients in the next year or so? And what else would you like to share that may differentiate what you guys are doing from other firms?
So we've taken the view that our approach has been, as we've moved to like mobile apps, that the best thing we can do is make sure your advisor, so Randy and Carver, their group, have all the tools to reach out to you. And so most firms have gone to what I call retail apps, trying to reach out to you directly, but the purpose isn't to give more advice, it's to be able to take money direct and disintermediate the advisor, which we think is dangerous. So as we've rolled out these robust tools to our advisors, we are now trying to put that same world-class delivery in our tools, that your client access, which works well, but is to really make it unique and robust and really give you an intimate relationship electronically, not just with Raymond James, which you'll need for information, but your advisor. So that's been the focus of the next rollouts in our tools. We continue to provide services. I think what makes us unique is if you go to most, brokers, sure, some have a bank, most don't. Some have a trust company. We have those, but we have a whole financial planning unit that's there, whether it's estate planning, alts, which are very sophisticated for those who need them, to help advisors on very complicated cases. So those resources. We bought what I call an insurance processor, not because we wanted to be in the insurance processing business, but we wanted to help with insurance cases. Our advisors give you the very best service. We just bought a plan administrator for the same reason on 401k plans, is to make sure that the highest service levels you could get if you choose our administrator. And you're not calling, if you have an issue, a strange firm where you're one of a zillion clients. You're calling Randy, you're calling Raymond James, you're calling people who care about your whole account, not just one service. And the purpose of that is just to give you better service, be able to help advisors as they have more sophisticated choices. We learned a lot in Alex Brown. They joined us really because of their unique ultra high net worth business. Now we have a lot of ultra high net worth clients before Alex Brown, but since their business was focused on that, they really helped us create an alternatives desk, a private investment desk for people that had investments between the two, between high net worth clients, really hone some of the lending products. And those are for a very small percent of the people, but when they need them, Raymond James wants to be there. And we're going to continue to try to expand the services that when you need something, you can come and we can give advice, we can review things, even if you have outside providers, just to give the best possible service. And that hasn't changed, because at the center of what we are is client first. And so that's going to be our focus going forward. And again, if you do well, Randy, advisors do well, and we do well, we never forget that. A lot of firms try to figure out, how do I cut costs? How do I shortcut? How do I limit products because I don't make money to help me make money? We take the opposite view. We say, what's good for clients? What's good and fair for advisors? How can we help them? And if we get that right, we'll do well. And that's been the secret over almost 60 years for us, over 30 years for Randy, and we have no interest or no discussion of ever changing that.
Yeah, that's great. And I think it's a good point. As I've explained to people, there's a number of affiliations with Raymond James. There are people that are employees on the advisor side, and they're independent offices, as are we. So, we have a choice, and we could go anywhere, but we choose to work with Raymond James. But at no time do they ever push a product or service, because frankly, we are an independent business. And so, I think that's a unique and a beneficial thing for everybody. So I guess the last thing I would say, we've got, almost 1,000 people listening, and I'm sure we'll have some more people look at this later. Is there anything else, as we look ahead, that you'd like to share, with the clients at this point?
I just really want to reiterate something you said, Randy, is that it's something I've always admired about you is a lot of people just fear change. They fear volatility. They fear, what's going to happen. And that's a normal human reaction. But honestly, there's going to be change. There's going to be volatility. There always was. The markets were going to go away in '08 and crash and never come back. And they've had the best 10-year run in history in this last year, as Randy discussed it earlier. And it's not to be afraid of change. It's try to look at it, anticipate it, and react to it. So, and Randy's always been one of those. It's been great as advisors. If we come out at the firm with some new tools, or we want to change something, most people, oh no, I want it. And he goes, oh great, now how do we do this? Now how does it benefit? How can we do, and that attitude of you want to be cautious and conservative, we are, but that attitude of saying, okay, here's the world, here's the changes, how do I react, gives a much better positioning for your portfolio and your success versus, going into a shell and saying, I'm afraid, I'm not going to go in. And I'm a great believer too, is invest for the long term, be smart, have enough for a rainy day, and you'll do well. And I can't imagine people not in the equity markets this last decade, what a difference it is. So don't be cautious, but don't be afraid. Change is going to happen. A lot of these things are going to happen that Randy put up on the tax. They're going to happen. I don't know which ones or how much. We just ought to prepare for them and react to them and then go forward, because there's not really other choice. You don't want to be a victim to the changes. So you need to do the best you can with them and pivot and then go forward again.
Yeah, it's interesting. A lot of people may not even know who Justin Trudeau is, but the Prime Minister of Canada, his father, Pierre, was at one point as well. But he had a great quote a couple of years ago where he said, never has the pace of change been this fast, and never will be this slow again. So I think, it's a great point, because things are just, if I look back 30 years ago, the high tech was a fax machine. The internet didn't exist. And I think about what's going to happen in the next 10 or 20 years. It's amazing. Science fiction becomes science fact. So, I really, really value the relationship, and I appreciate your taking time today to speak with our clients. That's just very typical of how great the accessibility has been for us, for our entire team. And having Raymond James as part of the team is truly, I think, what helps us. Just as with us, it's not me, it's Nancy and Bobby and Mark and Nick and Gail and Raj and Dan and Joe, et cetera, that really helps. So, we're here to be an enduring firm for our clients, regardless of what happens. And clearly Raymond James is too. So we really, really appreciate your coming in today and sharing your thoughts. Thank you.
Thank you, Randy, and thanks for the opportunity.
So last thing, as we've said, if people have questions, please call your advisor. Scott, I don't see if we have our last slide. I'm seeing Raj is on the screen somehow, but everyone's seeing Raj. Yeah, hi, Raj. We do have a number of events coming up, which you should see on the screen in a minute. The next event will be with Brian Westbury in March. We don't have a date set. We do plan on doing the golf outing. That may be our first live event. Of course, we'll have to see what happens with COVID, et cetera. And then we, again, with the city of Willoughby, have Wings and Wheels. And finally, the captain's game, along with some other things. The trip, a lot of you have asked about for September at this point. We do plan on doing the trip. We have about 80 people signed up. There is still space. We'll have to see what happens, but I am confident that by next September, things will be back on track. Obviously, with safety protocols in place, probably have to have a vaccine and a negative COVID test, et cetera. So, what's next? Again, it's all about asking the right question. And part of that, I think, is seeing beyond the noise and the hype, just taking a breath, and again, calling us. With the right planning, what happens just doesn't matter. Whether it's questions about assets with us, if you have friends or family who want a second opinion, we're happy to do that without cost or obligation. As Raj said, we and Nick said, we're a referral-only practice, but if you refer someone, we're happy to speak to them at any time without cost or obligation and see if there's a fit. As we look ahead, it seems that every year we talk about what's going to happen and we're surprised. No matter what happens, we will be here for you. And as always, your vision is our priority. So thank you for joining us on this Saturday morning and have a great weekend.